Okay, let's jump right in. We are starting off today with a pretty bold, provocative claim from Chris Blunt, the CEO of F&G Annuities and Life. When a chief executive goes out there and publicly states that the market is basically missing the true value of their company, well, it's our job to put that claim to the test. Welcome to today's Explainer, where we're going to run a complete, rigorous stock analysis of F&G. We're not relying on gut feelings here. No way. We're going to put this company through the ultimate ringer using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Plus, we'll run some modern quantitative models just to see if the hard data actually backs up the CEO's confidence. Here is our quick roadmap for today. We'll start with a company snapshot, then view it through the Buffett, Lynch, and Graham lenses, run a DCF valuation, and finally wrap up with a synthesis and final verdict. All right, let's dive right into Section 1, the company snapshot. So, F&G is a major player in retail annuity and life insurance. But the most important thing you need to understand right off the bat is this massive structural tailwind they're riding. It's called the Peak 65 retirement wave. Literally 11,000 Americans are turning 65 every single day through 2027. That is a staggering number, and it creates unprecedented demand for guaranteed income and retirement solutions. Now, lock this number into your brain right now. $30.84. That's the current stock price, and it's our ultimate benchmark for everything we're about to do. We need to figure out, is $30.84 a total bargain, fairly valued, or completely overpriced? Let's pull some core stats from our source data. We're looking at a $4.15 billion market cap, an estimated earnings per share of $3.66, and a book value per share of $32.75. We're going to be using these exact figures heavily in the math ahead, so keep them handy. Moving on to Section 2. Let's evaluate this through the eyes of the Oracle of Omaha himself, the Buffett lens. Buffett is always hunting for a durable economic moat, and F&G absolutely has one, backed by a record $74.5 billion in assets under management, and that massive Peak 65 wave we talked about. Buffett also demands honest, shareholder-friendly management, right? Well, F&G just authorized a brand new $100 million share buyback program on top of their regular dividends. Plus, when you calculate approximate owner earnings, they are tracking around $248 million in net earnings. That is a cash-generating engine Buffett would definitely admire. But you have to weigh profitability against debt. Buffett loves a high return on equity and manageable debt loads. F&G is sitting on a solid 8.4% adjusted ROE, and they returned $67 million to shareholders in the first quarter alone. Now, they do have $2.23 billion in notes payable, but when you zoom out and see they have over $101 billion in total assets, that debt is completely manageable. Honestly, F&G looks like it meets Buffett's criteria for a wonderful company at a fair price. Okay, Section 3. Let's switch gears to the Peter Lynch lens, looking for growth at a reasonable price. Just a quick refresher before we run the numbers. Lynch popularized the PEG ratio to find stocks where growth outpaces the valuation multiple. Basically, a PEG of 1.0 means a stock is fairly valued. Anything below 1.0, you're looking at a potential bargain where you're paying very little for future growth. And this is where it gets exciting. F&G has a PE of about 8.4 and an estimated growth rate of 17.8%. That gives them a phenomenal PEG ratio of just 0.47. That is well below the 1.0 threshold, which tells us the market might be severely underpricing their near-term growth potential. If we drop F&G into Lynch's categories, they fit perfectly as a stalwart, a large established company that still pumps out steady, dependable growth. Looking at their rock-solid balance sheet, that high growth rate and heavy corporate buybacks, like repurchasing 1.2 million shares for $29 million recently, Lynch would likely view this as a flashing neon buy signal at these levels. Let's move to Section 4 and apply the incredibly strict, deep value principles of Benjamin Graham. If we run F&G through Graham's defensive investor checklist, they honestly pass with flying colors. Adequate size? Yep, 4.15 billion market cap. Earning stability? Check. Reliable dividend record? Absolutely. But most importantly for Graham, it trades at moderate multiples, an 8.4x PE and a price to book of 0.94. That means it's literally trading for less than the liquidation value of its net assets. So since it passes the checklist, what exact intrinsic value does Graham's famous formula spit out for this stock? Let's do the math.
You take the square root of 22.5, multiply it by the $3.66 EPS, and multiply that by the $32.75 book value per share. The result? An intrinsic value of $51.93. When you compare that to today's $30.84 price tag, Graham's formula is giving us a massive 40% margin of safety. He'd probably be backing up the truck right now.
All right, Section 5. Let's stress test these old-school gurus with some modern DCF and alternative valuations. We built a base case discounted cash flow valuation here, forecasting out 5 years. Using a standard 10% WACC and a 2% terminal growth rate, our base case gives us a fair value of $42 per share. Even if we get super conservative, bumping the discount rate up to 11% and dropping terminal growth to 1.5%, the fair value only drops to $36.10. That is still well above the current price. Look at how these models converge here. It's actually pretty wild. Whether we use the baseline DCF of $42.00, assume a super conservative 10x PE multiple giving us $36.60, or use the Graham formula at $51.93, all of these completely independent models point to a fair value that is significantly higher than where the stock is trading right now. So, Section 6. Let's synthesize all this data and get to our final verdict. This summary table really lays out a clear, undeniable consensus. Across Graham, a conservative DCF, and comparable PE multiples, F&G is showing an implied upside ranging from roughly 18% on the low end all the way up to nearly 70% on the high end. No matter how you slice the math, this stock looks like it's on sale. So here is our final verdict. Based on our analysis, F&G is a strong buy at current levels across basically all our frameworks. The strengths are just undeniable: a 0.47 PEG ratio, a 40% margin of safety, and those huge demographic tailwinds. Now, you do have to keep an eye on risks, specifically macro interest rate sensitivity and alternative investment yields. But wait, there is a hidden bonus here. They have a sum-of-the-parts gem called Peak Altitude. It's their owned distribution franchise, generating $80 million in EBITDA, and management is actively exploring strategic alternatives for it right now. I'm going to leave you with this one provocative thought. If our modeling proves that the core insurance business alone justifies a $40 to $50 share price, just how deeply mispriced is F&G when you factor in this booming, capital-light distribution channel that the market seems to be completely ignoring? Thanks so much for joining me on this explainer. Keep asking the hard questions, always trust the data, and I'll see you next time.